Get ready to find out why investing in SCHD in 2024 could be a big mistake. Daniel Jones's article titled, "There's Almost No Reason to Own This ETF," criticizes the Schwab U.S. Dividend Stock ETF, commonly known as SCHD. At first glance, the article seemed like a typical clickbait, but considering that Jones has over 30,000 followers on the platform, it's worth taking a closer look at his claims. First, let me admit that I personally believe in SCHD and discuss it often on this channel. I have always maintained that whether you are a dividend growth investor or a high-yield income investor, it is essential to have at least one dividend growth ETF in your portfolio. It doesn't have to be SCHD. Alternatives like VIG and DGRO work just as well. The key point is that these ETFs help grow your income to keep up with inflation, which is very important for income-focused investors. Now, according to Jones, SCHD is an underperforming investment that will likely underperform the overall market. He emphasized that the composition of ETFs has changed, with financial and energy stocks gaining prominence, and alternative ETFs like SPY and QQQ are improving overall returns. Here, I immediately noticed a major flaw in his argument. Jones appears to be combining two different investment strategies: dividend investing and index fund investing. Dividend investors focus on regular dividend income, while index fund investors focus on capital growth. SCHD is aimed at those looking for a steady stream of income through dividends, not necessarily the highest total return. Jones's comparison to SPY and QQQ overlooks this fundamental difference. If maximizing total return is your primary goal, SPY or QQQ may be a better choice. But for those focused on generating passive income, SCHD remains an attractive option due to its reliable dividends and growth. SCHD is targeted at income investors who value steady dividend growth, making it a good choice for a stable, predictable source of income. Below, Jones criticized the stock selection criteria within SCHD, noting that they require at least 10 consecutive years of dividend payments and a market capitalization of at least $500 million. He argues that this focus leaves potential profits untapped, suggesting that higher returns could be found in REITs, MLPs, and BDCs. While it is true that these asset classes often offer higher returns, they also come with higher risk and lower dividend growth rates. The stability and quality of the companies selected by SCHD ensures a more reliable source of income that balances returns and reduced risk, ensuring consistent dividend growth over the long term. A balanced approach for dividend investors is to hold high-yielding assets such as REITs, MLPs, and BDCs in combination with dividend growth ETFs such as SCHD. This strategy provides a growing stream of income that is important for offsetting inflation, especially in retirement. While high-yielding assets provide immediate income, dividend growth ETFs like SCHD grow dividends over time. SCHD's focus on high-quality companies with stable dividends makes it a reliable part of a diversified dividend portfolio. This combination not only maximizes current income, but also ensures future income growth, providing a comprehensive solution for long-term financial stability and inflation protection. Jones then highlighted recent changes in SCHD's sector allocation, noting the rise of financial and energy stocks and the fall of industrial and technology stocks. While he interprets this negatively, I see it differently. Sector allocation adjustments reflect market dynamics and the ETF strategy to maintain a robust dividend yield. For example, energy companies are known for paying high dividends and can be beneficial for income-oriented investors looking for a reliable source of income. Similarly, financial stocks often offer high dividends, providing stability to the ETF. These sector changes are strategic decisions aimed at maximizing dividend payouts and ensuring the ETF remains attractive to dividend investors, even if it means moving away from previous allocations. Despite these changes, SCHD has remained true to its core strategy and has delivered strong performance over the long term. Historical data shows that SCHD has delivered an average annual return of approximately 12.57%, significantly outperforming the market's average return of approximately 8 to 10%. This impressive performance demonstrates that SCHD can deliver both capital appreciation and robust dividend growth, making it an attractive choice for income-oriented investors. The ETF's consistent track record of high returns and solid dividend growth supports its effectiveness in achieving its investment objectives. It's hard to argue against an ETF that has consistently delivered such impressive results, proving that its strategic adjustments and sector reallocations have not hindered its overall performance and appeal. Jones's assertion that SCHD has recently underperformed SPY is valid, but it misses the full picture. Dividend investors value income stability and growth over short-term performance fluctuations. While SPY may have outperformed SCHD in recent years, it is SCHD's long-term track record of reliable, growing dividends that really matters to income-focused investors. This continued income stream is crucial, especially for those who rely on dividends for passive income in retirement. SCHD's popularity among dividend investors stems from its ability to provide a stable, growing dividend, making it a valuable component of a balanced investment portfolio focused on income generation. In summary, Daniel Jones makes some points worth considering, but his overall case against SCHD is weak. His main criticism centers around the fact that SCHD has not performed as well as SPY or QQ in total returns, which, as we have previously discussed, detracts from the primary purpose of dividend investing. For those focused on generating passive income, SCHD continues to offer an attractive combination of high yields, low expense ratios, and strong dividend growth. These attributes make SCHD a valuable investment for income-oriented investors who prefer steady, growing dividend payments over short-term capital appreciation, ensuring a reliable source of income that will grow over time. So, should dividend investors sell SCHD? Absolutely not. SCHD remains one of the best diversified dividend growth ETFs available, providing stability, growth, and excellent returns. It's crucial to understand why you hold a particular investment and how it fits into your overall strategy. For income investors, SCHD's consistent performance and growing dividends make it a solid choice. Its combination of high yield, low expense ratio, and robust dividend growth ensures a reliable income stream. As always, I'd love to hear your thoughts. What do you think about Jones's arguments? Do you hold SCHD or prefer other dividend ETFs? Share your views in the comments below. And if you're interested in seeing my personal dividend portfolio and getting updates, check out my Patreon. Thank you all for watching, and until next time, take care.